The European Central Bank has cut interest rates to a record low. In addition, the ECB also reduced its deposit rate, which acts as a floor for the money market, to zero from the earlier quarter percentage point. The ECB aims to breathe life into a deteriorating EU economy, but steered clear of any drastic measures such as buying government bonds or flooding banks with fresh liquidity. European shares extended gains on the decision before turning negative after the ECB President Mario Draghi said that the Eurozone would recover only slowly. Now, Draghi highlighted the threat from the several EU members and banks' unwillingness to lend. Okay, and how did US markets take into the ECB action? And stocks there edged down as economic stimulus measures by the major central banks failed to excite investors. Now, trading volume as well was light after the 4th of July US market holiday and before the June non-farm payroll data that is slated to come out today. The US jobs report is expected to show muted growth. Financial stocks weighed heavy on Wall Street yesterday as Wall Street was little impressed by the actions in China, Europe and Britain to loosen the monetary policy, which sent the euro lower against the US dollar. And on closing bell, the Dow was down a good 47 points. The S&P 500 index as well, lower by 6. And the Nasdaq Composite ended flat for the day.
So I guess Wall Street last night clearly played it safe ahead of the jobs data. But Asian markets selectively are looking strong on hopes of strong regulatory action. So the big talking point this Friday morning is that most of the major central bankers have moved. They've announced a rate cut, which means in the near term, central bankers are now worried about growth, and growth scare, in fact, has prompted them to cut rates. If you check on other basic indicators such as crude, global volatility, and if you also check in on gold and other metal prices, nothing very impressive, honestly. Gold is at 16.05, silver is at 27.7. Check in on the dollar index. Dollar index is certainly below 82, but okay, it's below 83 now. So 82.87 for the dollar index. The unfortunate bit here is that last night global volatility has shot up, even though the global volatility, which is CBOE VIX, it is south of 20, but it's still appreciated by about 5% plus last night. But what about our markets? Okay. China too has cut interest rates for the second time in less than a month in a clear sign that growth is slowing down more than expected. The People Bank of China said country's benchmark one-year lending rate will now be lowered by 31 basis points effective today, while the benchmark deposit rates will be cut by 25 bips. Beijing is set to publish a draft of data next week, including gross domestic products for the second quarter, and it has a history of acting preemptively when data is historically been weak.
Okay, let's get you some more perspective then. Joy Yang, Mirae Asset Securities, joins us from Hong Kong. Joy, hi, morning. Firstly, second rate cut from China in about a month. What's your reaction to the PBOC cutting rates? Is it necessary, and how many more cuts do you expect?
Well, I think talking about interest rate cut, we do ask 3 questions. Can they, should they, and will they? I think in terms of can they, yes, they can, because inflation is no longer a concern. But in terms of should they and will they, we were talking about that the first rate is probably should move, reflecting concerns on the external environment. But this cut comes is probably not warranted because over the short term, China still relies more on quantitative easing measures rather than interest rate cut. And so we don't think that this interest rate cut is going to help much to boost domestic demand.
What is your view on inflation, and especially given the way how Chinese consumption demand of late has petered out? Do you think in China inflation, it's a matter of time, will come down?
Well, we are not surprised about the inflation side because since the beginning of the year, we have been projecting that July we are likely to see headline CPI hit a button of about 2% or even lower because of the high base effect. But in terms of the growth, I think it's a little bit slower and weaker than the government expected. That's why we were projecting earlier an interest rate cut around middle of the year. But at this moment, we think it's more sensible to use fiscal measures rather than interest rate cut to support growth for the rest of the year.
Joy, next week we have important data in trade inflation, the GDP coming out in China. What are your expectations? Would it be disappointing for the markets?
I think probably now we are going to see some stabilization in the GDP. Why? Because since the beginning of the year, we've already seen fiscal investment started to accelerate. So I think the less tightened policy stance starting from later last year, plus this acceleration in the fiscal investment, will likely to suggest that China's growth is going to stabilize in the coming months, and we're likely to see a rebound for the second half of the year. So that's why we're still projecting 8.1 annual growth for this year, and we think 8% is actually quite achievable.
Joe, the fact that Chinese economy is slowing down, do you think that will have a big impact on commodity prices?
We think in China's domestic commodity sector, they are stuck with the overcapacity issue, and also the inventory level was at quite high level. Because last year, not only they imported some of the commodity for the projects, which is the easing round from 2008 and 9, but also they imported lots of inventory for financing purpose. Since last year, the Chinese government has been tightening on the credit supply, and that's why lots of commodity traders has been importing commodities to get the financing they need. That's why we think the inventory level now is at very high level, and it will take some time to come down. And that means the commodity price in domestic economy in China will probably be dampened.
Joy, you got rates as well overnight. Is that the way to go, and how will this impact China?
Well, I think EU's cutting the rate is probably not a major reason that triggered PBC's second rate cut. Because still, I think the major monetary objective for China is to maintain a stable monetary base in the economy, as well as to support growth this year. But obviously, when ECB cut the rate, the Chinese government probably feel more comfortable because now they don't have to worry too much about the spillover effect from their easing effort going to other countries. So I think marginally speaking, yes, ECB's cutting the rate will make China feel comfortable with its more rate cutting.